Well, this afternoon, the Reserve Bank cut the cash rate down by 1/4 percentage point to 3.6% in what will be welcome news for mortgage holders. Here's Reserve Bank Governor Michelle Bullock earlier today.
The board's now cut the cash rate by 75 basis points since February this year, as we've become increasingly confident that inflation is on track to be in our 2 to 3% target range on a sustainable basis.
Former Treasury Assistant Secretary David Pearl joins me now. David, welcome. Not a surprise from the Reserve Bank, but welcome news nonetheless.
Thanks for having me on, James. Yes, it was welcome news for borrowers, although the Reserve Bank boards followed a fairly interesting path this year. We had the February rate cut just before the election, which many economists, including me, thought was premature and with a political taint. We had a further rate cut in May, and then in July, Michelle and the board seemed to get cold feet and they defied the financial markets by holding rates rather mysteriously, and now we had the rate cut today. So it is welcome, but I should say, James, that today's announcement was completely overshadowed in the press conference with Michelle Bullock by the bank's declaration or assumption that productivity growth would be cut by 30%. That is from an assumed 1% annual growth rate to 0.7%. And that is huge economic news, and it overshadowed the rate cut at the press conference.
Yeah, well, I want to get to that because, like you, I thought that was the big thing that came out of today's announcement. She didn't just slash the interest rate, as she said, she's downgraded the productivity growth assumptions and warned the economy would be worse off. Here's some of what she had to say about that.
For the purposes of our forecast period, we think that the productivity assumption needs to be a bit lower. We were hitting our employment and our inflation forecasts, but we were overestimating our GDP and our consumption forecasts. Part of the solution to that was that the productivity assumption was a little too high.
OK, so David, for everybody listening at home, the headline is interest rates have come down a touch. But as you say, the news on productivity, that's big and that's going to affect everybody. But can you explain in layman's terms what she's saying and what effect is that going to have on average people in their lives?
Well, what she's saying is that the Reserve Bank, for the purposes of its forecasting, over the next 2 years is assuming that productivity will grow by 30% less than it has been assuming up until recently. Now, let's not forget, James, that productivity has been flatlining in Australia since 2016. That's 9 years. So even assuming 0.7% growth is still optimistic. Now, when productivity comes down, sustainable wage growth comes down, profits go down, there's less investment, there's less growth. In fact, the RBA has made clear that the economy's maximum sustainable speed limit with less productivity, with less supply capacity, is now 2%. And that compares to 3 and 4 percentage points growth rates we saw in the 90s and early 2000s. So it's really an adverse judgment. The RBA and Michelle Bullock will say it's just a pointy head assumption, but it really is an adverse judgment about the economy's productive capacity and the scope for future living standards in this country to grow. I hope I've made sense in that, because a lot of economists get tied in knots when they talk about productivity, but it just means living standards, that we're going to not have them growing as much as we and our forebears expected.
Well, I mean, that sounds bad, but I mean, the good news is Jim Chalmers has got an economic roundtable next week. So surely a whole lot of great ideas are going to come from this talk fest that are going to address this issue, aren't they?
Well, Jim Chalmers is the man for the moment. I mean, we've all underestimated him. We thought he was just a superannuated media advisor, but maybe he's a Paul Keating, maybe he's a Peter Costello, and he's going to, prove that next week. I'm only joking for your viewers. I think this is a stitch-up, just like the Labor Party's Jobs Summit. We had a Jobs Summit in 2022 and we had maximum unemployment. It was really a ruse to get the union movement to re-regulate the labour market to the cost of all of us. And next week's summit will be no different. None of the fundamental shibboleths, if you like, of this government's economic policy are going to be questioned next week. Net zero won't even be mentioned. apart from looking at ways to rip up environmental regulations to allow wind and solar to be further rolled out across the land. There won't be any discussion about industrial relations reform because Sally McManus and 3 other unionists will veto that. And there won't be any discussion about how to control out of government spending. It'll just be about increased taxes. So this summit, under the guise of productivity and growth, will reinforce and seek a consensus in favour of the fundamental economic strategies of this government, which I think most voters have seen are not delivering higher living standards and growth.
David Pearl, appreciate you coming on tonight. Thanks so much for your time.